Hello, everybody. This is Toni Turner, and welcome to the Market Now as of Friday, October 1st at about 2:45 p.m. Eastern. And as you all know, it's October 1st, the very first day of the fourth quarter of this year. Okay, U.S. manufacturing activity picked up further in September, but factories experienced longer delays getting raw materials delivered and paid higher prices for inputs, the Institute of Supply Management said today. The slower supplier deliveries indicate persistent supply shortages related to the COVID-19 pandemic, and I'm sure we've all been affected by that. So now let's go on to three charts that could give us a little insight into the week to come. First of all, as we always do, we're going to look at a daily chart of the S&P 500 SPDR, symbol SPY. The SPY follows the S&P 500 index very, very closely, and as traders and certainly even investors, we follow the S&P 500 because during the times when the S&P is going higher, 3 out of 5 stocks in the market will follow it higher, and during the times when it's going lower, 4 out of 5 stocks will follow it lower. So it's kind of our guide, or sort of a crystal ball, if you will. And that is why we always take a look at this at the beginning of our session. Now, the SPY closed. It made its last all-time closing high right back here on September 2nd at $453.19. That's $45.31 on the S&P 500 itself. Now, when I captured this chart today, however, the SPY has fallen, and today it's down to $434.08 when I captured this chart. So it's trading now about 5% below its prior all-time closing high. Now, so far today, though, we're looking pretty good. Price is holding near the high of the day, and today's low is down here at $427.23. So it really, to stay positive again, it really needs to hold here. As you can see, since this this all-time high that we had back in September at 453 and change, it started falling from there, fell below the 20-day moving average, the red line, the green line, the 50-day moving average, fell down to about 429 or so, and then jumped back up, got up to the 50-day moving average, and I said on Twitter, if it doesn't hold here, we're going to have another leg down, and it didn't hold there, and we did get another leg down. So, but not a really horribly bad one so far. So now again, as I said, we're at $434.08. We're going to need to hold here. We very definitely want to do that. Our resistance still is up here at 454. Of course, we can certainly say we have resistance here at the 50-day moving average and the 20-day moving average right around 442, 443. Remember, what used to be support is now resistance or potential resistance when price falls below it. So price has definitely fallen below the 20 and the 50-day moving average. So that could cause a resistance zone right there if price starts back up toward that 442, 443 zone. Today's low, again, as I said, is 427.23. Needs to hold here. Needs to hold here. If not, then the next potential support level is down here at the 200-day moving average, the black line. That's at $412.79. And of course, then we can always go back to our May lows back here if we want to look for another level. I don't know if I can draw this straight or not, but that comes in at about 407. So again, as I'm used to saying, plenty of potential support here, but obviously less than we used to have since price has already fallen below. Now we see quite a bit of volume coming in here, quite a bit of activity, We also know that seasonally speaking, September and October can be very volatile months. So please keep an eye on your protective stops. And if you're not sure what to do, remember the sidelines can be a great place to be. And remember, too, that cash is a perfectly valid position for your money. Cash is not a bad thing sometimes. So that's always a place to go. Our next chart today is the Invesco QQQ. Of course, this is the ETF that closely follows our NASDAQ 100 major index in the market, with our top momentum stocks in the top holdings, including Apple, Amazon, Alphabet, Facebook, Netflix, that whole group. So usually more volatile than the SPY. Now, it made its last all-time closing high back here in September, at September 7th, actually, at $382.11. And then when I captured this chart today, it's down here at $359.43. So just like the SPY, it's fallen. It made its all-time highs in September, then fell down below the 20-day moving average, the 50-day moving average. Certainly fell through it, rallied back up and over the 50-day, and everybody thought, oh, good, everything's fine. And then, of course, the market being the market, it rolled back over below the 50-day moving average, and again now is down as we speak at $359.43. Resistance remains up here at $383. We have price again falling below the 50-day, so we do have resistance up here at 370, 371, where the 50 and the 20-day moving average are coming in. We have July lows down here at 352, so that's down. I can't draw this straight, but it's right down about there. So we do have support here at 352, potential support. Then we can look down here at the April highs, see where that resistance is, and it fell back down. So we can use that again. That's at about 342. That could act as support. The tops of pivots can be used as supports just as the bottom. So then it's coming in at 342, and of course our 200-day moving average coming in at $340.18 right now. We did say back a couple of weeks ago, if the SPY and the QQQ did dip below the 50-day moving average, it would be less bullish. That is true. It is less bullish. Now though, we wait to see where the bottom, the so-called bottom, is for both of these indexes. And that is something that actually takes a little while to form sometimes, or at least a little while to spot. So if you do buy the dip, if you do buy any of this dip here, and buy the dippers will certainly come in depending on what happens in the coming week, I do encourage you to put a stop, a protective stop with your broker on any trade where you are buying the dip, just in case that wasn't the bottom and it rolls over and starts lower again. Because when we get a real low in, it's a lot of traders can't wait, but what you really need to see then is a higher low. So this would be the low, and then you want to see a higher low to confirm that buyers are buying when it starts to fall again. So that's what you would see here, and a lot of you don't want to wait that long. That's fine, but please do put a protective stop on any of your trades where you're buying the dip. It just makes sense to protect your capital at all times. Okay, our final chart here is a chart of the iShares U.S. Oil Equipment and Services ETF, a daily chart, symbol IEZ. You all have probably noticed that the price of oil is going up recently, and because of that, of course, so is the price of oil-related stocks. And this, again, is the iShares U.S. Oil Equipment and Services. We've got 26 holdings in it. Some of the top holdings are Schlumberger, Baker Hughes, Halliburton, Helmerich & Payne, Transocean Offshore. And when I captured this chart today, the IEZ was trading at $14.25. Now, it did have a recent high back up here in June at $17.17. Then it fell in a pretty strong downtrend from there, all the way down to about 1250 or so, down to its 200-day moving average here. Had a little bump up rally, then made a lower high, so the downtrend continued at a lower high down to these lows here. The August lows were at $11.59. So that's a pretty big percentage of a loss. So then it rallied back up again, up over the 20-day, which was inverted to the other two. Then dallied around here a little ways through August, through September, back down again to about 1230 or so, then rallied back up to where it is now and is finally punched because of the rise in oil prices, has punched up above this 50-day, 20-day, and 200-day moving average for the first time in quite a while, and made a higher low here. Remember I just talked to you about higher lows? Higher lows are important. This is a higher low, and that's a higher low. Higher lows are very important because it means that buyers don't wait until it comes back down to retest the old level. They buy before it comes back down. So that's why we're looking at it here. If in the coming week, if the IEZ can stay above the 200-day moving average, and that's pretty tight here. The 200-day moving average is coming in right now at $13.67. So in the coming week, if the IEZ can stay above the 200-day moving average, I will add a probably small position to my trading portfolio. I'm going to put my initial stop down here at 1250. Now, if and when, and it's pretty close here, if and when the IEZ rises above 1460, that will be above this little prior pivot point here. If it rises above 1460, I will add to my position, and of course by then my stop will be a trailing stop. So you may want to keep an eye on the IEZ in the coming week. Now, before we go on to final thoughts, please know that if you'd like to become a more successful trader, please check out my trader training programs. You will like my simple strategies targeted to swing trading, trend trading, bottom fishing, and more. All of my programs can help you increase your gains quickly and easily, and to see them all, simply go to the link on this screen right here, or easier still, just click on the orange button below. And now on for our final thoughts. Our question for this week is, when I make a winning trade, if I don't exit at the top of the upswing and I give some of my potential profits back, then do I chastise myself for not getting out at the top? And I know a lot of traders who do this, and I did it myself back in the old days. When we make a successful trade, yet spend time berating ourselves for not getting every penny of profit possible, I think we inflict pain on ourselves needlessly. Please know, you guys, nobody enters a trade at the bottom price of the exact bottom price that turns out to be the bottom of an upswing. Nobody enters a trade there and then sits quietly and watches it go up to the top of the move and then takes profits at the very, very top. It just hardly ever happens. What our goal is to take a chunk out of the middle of an upswing or a downswing if you're selling short. So if you take this center out of the Oreo here, you're doing a heck of a good job. That's our goal, to do that over and over and over again. Worrying about and berating yourselves for missing gains is a total waste of time and energy. Instead, we should be congratulating ourselves on following our plan and pocketing our profits. When we acknowledge our successful trades, such as the ones I mentioned earlier, we improve our trading self-esteem. And that feeling of pleasure urges us to go ahead and do it again. Now, look, as far as your losses go, there's two ways of reviewing them. If you make a mistake that loses you a lot of money because you didn't have a plan or because you ignored your stop, then you need to review it and see where you went wrong and plan to not make that mistake again. However, if you always follow your plan and you exit when your stop is hit, then consider reviewing the results of your trades in groups of 10 to 20. That may give you a more accurate picture of your winning percentage. Look at 10 trades in a row and see what the winning percentage is there. Hopefully not losing, but if it is, that's a really more accurate way of doing it, as long as it isn't a big fat mistake. So finally, when we feel good about ourselves and we praise ourselves for the right actions, we will tend to repeat that action and then become more skillful, which builds on our strengths. So the bottom line is praise yourself for successful trades and learn from the ones that aren't. Your confidence will rise and so will your profits. Finally, please know that this is a great time to check out my trader training programs. To see all of my online training programs, simply go to the link on this screen or click on the orange button below. Until next week, keep green on your screen. I'm Toni Turner, and this is The Market Now.